Good afternoon, ladies and gentlemen, and welcome to the CALNEX Solutions plc results for the 6 months ended 30th of September 2021 investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted any time via the Q&A tab situated in the right-hand corner of your screen. Just click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. These will be available via Investor Meet Company dashboard, and you'll be notified once they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Tommy Cook, CEO, and Ashley Greenen, CFO of CALNEX Solutions plc. Good afternoon.
Thank you, and good afternoon, everyone. And thanks for coming along to hear the interim results from CALNEX for the first half of FY22. Before I get started, let me just tell you a little bit about myself and my colleague Ashley, who's here with me today. My name's Tommy Cook. I'm the CEO and founder of CALNEX. I founded CALNEX back in 2006 after spending 23 years working in the telecoms test sector. And at that time, I seen an opportunity for a new type of test equipment, and that's when I set up CALNEX. So I'll pass over to Ashley and let her introduce herself to you.
Thanks, Tommy. Hi everyone, my name's Ashley Greenen. I'm a Big Four trained CA. I qualified with Deloitte and followed that by 5 years at KPMG in their transaction services teams in the UK and Australia. And then since then, I've worked in various group finance roles across a number of industries, including the testing and engineering sectors in both private equity owned and PLC businesses. And before coming to CALNEX, I was CFO of a private equity owned multi-site engineering business headquartered here in Scotland.
Okay, thanks, Ashley. So before we go into the results, let me, for some of you may not be so familiar with CALNEX, let's just have a quick overview of who CALNEX are, and then we'll go into the actual results. So CALNEX designs, produces and markets test instrumentation for the telecommunications industry. We in particular focus on the network synchronization and network emulation sectors of that space. Our solutions are used to validate the performance of critical infrastructure, either through the design phases or once it's actually deployed in the networks around the world. We're at the forefront of the sectors that we work in, and it very much is a global market. To date, we have shipped products to over 600 customer sites in 68 countries around the world. And we've been successful in all the major subsectors within the telecom space. That's with the vendors making the equipment, the operators that build and operate the networks, and the component suppliers that make this components and sub-assemblies to get built into the equipment. We also have been successful with some of the large enterprises that build their own networks, and increasingly with the hyperscale companies that are building the data centers around the world. So where does test and measurement fit in telecoms? Well, it fits in just about everywhere. It doesn't matter if you're starting to design a new piece of equipment, you're verifying your design, you're manufacturing new equipment, or you're building networks or maintaining networks. You need different types of test solutions in all these stages. The ones that we focus on are highlighted there on the screen. The R&D design validation and conformance test is a key area for us. So this is where R&D engineers are building new pieces of equipment to be deployed in the network, and they need to go through and make sure the design's accurate and it's doing everything they expected it to do. And of course, if they're claiming conformance to any of the international standards, they need to run tests to ensure that they actually do conform to these standards. And very much in that space, we're an enabler to our customers. We're enabling them to get their product to market and create new revenue streams themselves quickly. And it's not just quickly as in fast, it needs to be robust as well. They need to make sure they've got good design margin, that once it goes into manufacturing, they're not going to have a yield problem. And they're going to have to make sure that it actually meets the international standards, and it is going to work in all the various topologies that the equipment will be put in once it goes out into the field. Because if it doesn't, then obviously they're going to have customer satisfaction issues. So very much we enable them, and having the right product at the right time enables them to get their product to market quickly. The one other area that we focus on is maintenance test. Now, these days, installations are straightforward from a test point of view, in that they'll connect it up, run some fairly straightforward tests, and if it seems to work, they'll leave it. And even first level maintenance is much the same. They'll come along and swap cards or pieces of equipment out to see whether that fixes the problem, and if it does, all good. But if it doesn't, it means there's something more complex going wrong in the network, something about the topology or the setup at that point in the network that's stopping the equipment working. And that's the bit that we focus on, because the engineers then need equipment that gives them deep insight, and that ties into what we do back in the R&D phase, which gives them deep insight to the equipment during that R&D stage. As I mentioned, there are basically 4 sets of customers that we have shown on this slide. If I start top left, we've got the equipment vendors. So these people like Nokia, Ericsson, Cisco, Huawei, they actually build the equipment, build the switches, the routers, the base stations to get sold to the operators to build a network. And we very much sell to their R&D groups. So it's that R&D stage that I talked about, is they're developing new pieces of equipment and they need to test their new equipment to make sure it's working. And that group roughly represents around 55% of our business. The second group in the bottom left is the network operators. So it's BT, AT&T, China Mobile, people that build and operate networks around the world. Now, obviously, we sell them our maintenance testers that they use to maintain the networks. But actually, especially for the large operators, they have proof of concept labs where if they're interested in purchasing new equipment to get deployed, they'll actually bring it into the proof of concept lab first and evaluate it before they actually deploy it in the network. And again, they do a very similar testing to what happens back in the vendors in their verification stage. So they'd actually buy our R&D testers. They don't buy a lot. It's not a big market, but it's a very important market from a food chain point of view, because if you were a Juniper or a Nokia taking your new piece of equipment to AT&T, you really want to know exactly how they're going to test it and make sure you've tested it first before they do, to make sure you don't end up having any unfortunate events in front of your major customers. The last group is the bottom left from a telecoms point of view, and that's the component manufacturers. So that's your Intels, Qualcomms, Broadcoms of this world. They make very sophisticated chipsets or sub-assemblies. They sell them to the vendors and then they get built into their equipment. They represent around 5 or 6% of, about 6 to 8% of our business, 6-7% of our business. So quite a small part of the business, but very important again, because they'll go and demonstrate their equipment to the vendors, and it's good that they're using our test equipment to prove conformance, prove performance at that time. So we try and cover the whole food chain. And then the last set, top right, there is a growing part of our business, currently in the low 20%. And this is the big enterprises that build their own networks, and more the hyperscale people are building the big data networks, the Facebooks, the Googles of this world that are actually building these large data centers and operating them. And in the future, we've got to get things like edge computing as well. So these are an interesting opportunity for us as well, and something we'll talk about a little later as well. So really what's causing opportunity for us is new developments. You know, the test and measurement world is driven by new stuff. In terms of when new things are developed, then obviously they have new challenges in improving the performance, making sure it's working, and they need to invest in that. So as the industry moves, the faster it moves, the more it generates new topologies, new types of equipment, new interfaces, new frame formats. That creates opportunity for the test world. And the two waves that we're really attached to at the moment is the build out of the mobile network, often referred to as the 5G. But for me, 5G is often presented as if it's a spot technology to the consumer world. But to me, it's really the euphemism for the evolution, or the continuous evolution of the mobile network to meet the needs of the smart cities of the future. Everybody wants more connectivity, whether it's more speed, more devices connected, more geographical coverage. It's just more of everything. And that's really what the telecoms industry is driving, to actually give that connectivity to everybody that needs it, and is creating a lot of opportunity. The other part is the appearance of cloud computing and the high-speed data, high-speed Ethernet world. Very much as you know, there's more and more discussion of people of equipment and services getting pushed into the clouds, and there's these huge data centers that are being built at the moment. They're also talking about edge computing as a way of actually distributing that, and that's creating a lot of change in the industry. They drive to very high rates, which is bringing new very high speed interfaces. All these things are creating opportunity for CALNEX. So that's who we are as a kind of general overview. Let's have a look at H1 in FY22. Well, it's been a really good period for us. both we've exceeded our revenue and profit before tax targets that we set at the beginning of the period. Our revenue, we did 9.3 million, which was 20% growth on the half year of the previous year. We generated 2.3 million of adjusted PBT, and we generated additional cash that our closing cash is now up to 13.6 million. We also said when we went through the IPO process that we'd start to pay a dividend in FY22, and we've followed through on that by announcing a first maiden interim dividend at 0.28p per share. Now, if we kind of look where that growth in our business is coming from, you can see by the three main regions of the world, or how we divide the world up, that it's coming from two in particular. So we have on the left the Americas, we have on the right North Asia, which we call North Asia really China, Japan, Korea and Taiwan, and then the rest of the world is in the middle one. But the biggest chunks in there are Europe and India. And you can see that the Americas, we had a great period. We grew 22%. In the rest of the world, driven mainly by India and EMEA, that it was 33%. And in China, it was pretty flat year on year. But that's actually what we expected. So we're actually pretty much in what we thought would happen in that period. I think with the geopolitical tensions there are, plus the general component shortage around the world, plus in China, there's more challenges with components where there are certain components they can't get access to anymore. We expected a softer period in China, and that's what's happened this period. So that's pretty much in line with what we expected. But we have exceeded our targets in the other two regions, which is great. So at that point, I'm going to hand over to Ashley, and she'll give you a bit more detail on some of the numbers.
Thanks, Tommy. I'm going to take you through the detail on the income statement and the cash flow on the next two slides. But before I go on to those, I thought it would be useful to briefly remind you of our revenue model. CALNEX generates revenues through the sale of bundled hardware and software, as well as software support and extended warranty programs. Bundled hardware and software sales pricing can differ for each order, as it depends on the hardware product being purchased and the numerous software option choices that each hardware product can offer. So each customer can purchase different combinations of software options for each hardware product, depending on their need. And once a customer has purchased a hardware product with software options, they can come back for upgrades and additional options that are added to the existing hardware through the provision of a license key. And we sell these standalone software options or upgrades as standalone transactions. And as a result of this variability, the average price per product can vary from transaction to transaction and order to order. And this revenue is recognised either on dispatch of the hardware item or delivery of the software license key if it's a standalone software, and makes up the majority of our revenue. On average, over the last few years, approximately 90% of our revenues were generated by these bundles and hardware software sales. And I'll show you a graph in a second where you can see that coming through. And that trend has continued into this year. Each of our products come with a standard warranty period, which can be extended for an extra fee. And we also sell software support programs, and that makes up the other 10% of our revenues. And that revenue is recognised over the life of the product, so because it can span over more than 1 year. Our top 10 customers are some of the largest in the industry, and over the last 3-year rolling period to March 21, the top 10 customers contributed to just over half of total revenues. In addition, the average length of relationship we have with our top 10 customers is 9 years, which demonstrates the repeat nature of the business we do with them. And we see customers come back to order from us frequently, as they may want to either buy multiple bits of the same kit for multiple sites, add new kit as they grow their labs and testing requirements. They may want to add new software options or upgrades, like I said before, to the existing hardware, or they may want to move on to newer products and functionality as they're released to the market. And that repeat revenue demand is a metric we measure across our whole customer base as well as the top 10. As you may remember from the full year results roadshow, in FY21, the 3-year rolling profile showed repeat revenues generated were on average 80% of total revenues, whilst the total revenue generating customer base grew from 139 in FY18 to 192 in FY21. And that repeat trend has continued into this half year. So just on to the income statement. We've included a profit bridge in this slide to help show the main movements between this half year and H1 last year, as there's a step change in our cost base for FY22 post-IPO as a result of our investment to support the growth of the business. And the H1 period last year was just before the IPO. So I'll refer to the bridge as we walk through the main income statement items, in case it helps. So, as Tommy said, we achieved revenues of 9.3 million in the first half of this year, and 20% growth on the prior year first half's revenue of 7.7 million. And this, as Tommy said previously, represented a significant positive variance on targets set at the beginning of the year, the financial year. And order intake and revenue had also increased across all three product lines. We went into the second half of this year with a healthy backlog and a good order pipeline, and we're expecting to meet the current market guidance for the full year results. Gross profit, just as a reminder, that's net of commissions to our channel partners, grew 17% on the prior year, and that's driven largely by the revenue performance. The gross margin percentage is 76% in this half year, compared to 78% at the same point last year, and that's largely driven by product mix. In a normal year, we can see fluctuations in margin by 1 to 2% each way, depending on the product mix, order, and shipping mix as well in the period. And on the profit bridge, you can see the first two blocks show the impact on the gross profit from the volume and margin variances between the two half years, just showing that net £1 million improvement in gross profit in this year, driven by, as you can see, predominantly by the increase in the actual revenue volumes. Profit before tax, and that's shown here as adjusted profit before tax here to take into account the adjustment for IPO exceptional costs in FY21. There's no exceptional costs in this current year. And so that was 2.3 million in the period, which, as you can see, is flat on the prior year. But as we've said in the announcement today, and as I said about the revenues, it's a material increase on initial management expectations at the beginning of this financial year. And as I also mentioned previously, one of the key drivers behind the variance to the prior periods is driven by our planned step change in our cost base for FY22, which was built into our forecast from the start. And that's driven by both a ramp up in the teams to meet and prepare for future growth. So that's across all teams, but in the admin costs, that would be sales teams, predominantly in the US and India, and in our management of the operations team, is to bolster that operations capability. And that just helps us meet and prepare for future growth. And then, of course, there's the change in costs that come just with life as a listed entity as well. So just on that, admin costs, and that's excluding depreciation and amortization at this point, and adjusting for the exceptional costs last year, were 3.2 million in this current half compared to 2.3 million in the previous year. And you can see that in the bridge as well. And as I said, this increase in admin costs can be split into two main categories. That's the increase in organisational growth and the staff costs that comes with that as we build the teams, and higher professional fees and share incentive scheme costs, just as a fact of life of being listed on AIM. We initially expected travel costs to increase in the year in this first half as a result of COVID restrictions being eased, but we've not seen that increase materialise just yet. The travel restrictions were predominantly still in place through the period in the regions that we work in. So costs are very much in line with this year. We expect these costs to start to ramp up as restrictions ease. Amortisation of R&D costs increased by 0.2 million in this half compared to the prior year. And again, that's as a result of increases in our R&D headcount as we ramp up for growth. And I'll talk about the R&D cash spend on the next slide in a second. And just as a reminder, R&D spend for us is capitalised and amortised over 5 years to the P&L. Tax charge is 0.5 million in the year, and that's in line with last year. The effective tax rate for this year is 22%, and it's driven by a combination of things. As you'll know, the UK corporation tax rate is due to rise to 25% from April 2023, which is FY24 for us, financial year-wise. So measuring your tax charge, you've got to take that into account we've got quite large deferred tax liabilities because of our amortization profile. So you've got to take that into account as you roll off those deferred tax liabilities at the higher rate. You've got to measure them at the rate that they're going to be. And that's offset partially by the availability of R&D tax credits for us. So we split our R&D tax credit exposure across two schemes. The large company scheme, because some of our projects are covered by grants, and the small and medium sized entity tax credit scheme, which you can take for some of the projects as well. So we expect this effective tax rate to be aligned to the effective tax rate for the full year. Earnings per share was 2.05 pence in the period, and diluted EPS was 1.99 pence, and that compared to 3.02 and 2.42 pence respectively in the prior year. The calculation the components of the calculation for EPS are not like for like across the two half years, purely because of the IPO in the middle. So what looks like a reduction in earnings per share has to take into account the change in the weighted average number of shares in issue pre and post IPO. We issued 27.5 million shares on IPO, and 50 million of them were share options. So that only comes into play in this current year's EPS and not last year's. So you've got to take that into account when comparing. There are also 3.1 million share options issued since the listing, which further increases the weighted average diluted share capital at the end of the period. So we'd expect this calculation to level out in future periods to aid the like-for-like comparisons, albeit with small increases in share capital in line with share issues and exercises of share options in the future. So just onto the cash flow. Sorry, just change my slide. As you can see from the next slide, the group generated 0.9 million cash in the half year, and that's in line with cash generation in the prior year half, albeit for different reasons. Net cash generated from operations was 3.1 million compared to 2.9 million in the prior year half, and working capital movements represented a cash outflow of 0.7 million, and that's mainly driven by increases in our trade debtors balances, which is a natural flow of working capital as we grow the business and our increase in revenues and shipping to customers grows. That then puts the trade debtors into a cash outflow position in a growth profile. Cash used in investing activities is predominantly cash spent on R&D activities. So as you can see, cash spend on R&D in the period was 1.9 million, and that's 0.4 million higher than the last half year. And that, again, as I said on the P&L, that's as a result of our ramp up in the R&D teams to support growth. Cash spend this half year, is 20% of revenues compared to 19% of revenues last year. And in a period of ramp up, we plan for this to be approximately 25% of revenues when we plan at the start of the year, which aligns to the guidance that the company has. And that's the metric is lower at the moment just because our revenues are higher than what we expected at the start of the year. Cash spend on financing activities is very small this year. It's mainly for lease costs in the half year, and that's compared to a cash spend of 0.6 million in the previous year, but a lot of that related to either pre-IPO fees or debt repayments on a loan that we paid off as part of the IPO funds. There's currently no debt on the balance sheet, and that leads to no borrowings related cash flows in the current period. And as Tommy said, closing cash was 13.6 million, and that leaves us in a very strong balance sheet position leading into the second half. And just lastly, again, as Tommy mentioned, we will be paying a maiden interim dividend of 0.28 pence per share, and that will be paid out on the 17th of December. Back over to you, Tommy.
Okay, thanks, Ashley. So let's have a look at what else has been happening on the ground and strategically. I guess through the year we've actually, as Ashley mentioned, we've accelerated a hiring program to put more people in region as well as in the development and support and business operations teams here in the UK, and we're continuing to grow the groups around the world. You know, if you've ever been involved in a young company that's growing fast, it's a requirement in every department that there's a continuous evolution of processes to deal with the growth. But every so often there's a need to make a bigger change. And one of these changes is coming in our manufacturing operations. So we've hired a new VP of operations really to look at the way we manufacture our products and take it forward so that we can we have sustainable growth going forward, or we're in a better position to have sustainable growth moving forward. So there's a major change coming here, but that's something that's happening in the background, and obviously is making sure as we continue to grow, we can continue to deliver product as customers expect. We got our accreditation from Investors and People this year, and this is something we're quite proud of, because we actually received a gold standard at first time of asking, which apparently very few companies managed to get gold for the first time. So that's something we're really pleased about. We do a lot of work to make sure people enjoy being here, enjoy working here, and work hard for us, and to have that external body recognise that us as a good employer was something we're very proud to achieve this year. And of course, as we start to move out of the pandemic, it doesn't seem to be over yet, but we kind of hopefully are in the end phase. We've started to move towards a hybrid working model where we do want our teams to come in 2 or 3 days a week, but then they can choose to work from home if they so desire, or come into the office, again trying to get the best of both situations of having office-based work to get team dynamics good, but also having the ability to get on and concentrate at home that a lot of people find, and also being able to balance work-life balance better as well. If you look at our products, there's been quite a lot happening. As Ashley said, across all the product lines have had growth this year, which has been really reassuring. And it's really our base businesses that's been growing. But on top of that, there's a few layers that have been really reassuring as well. We've had some, in the first half, we had 2 major releases, one on the Paragon platform and the LabSync program, and one on the Sentinel program. And these have been really well received by customers. And again, we would hope to see growth moving forward from these. And in the second half of the year, the Cloud and IT product line, we will introduce a virtual version of our SNE network emulator. Again, we expect that to get some good customer engagement and hopefully grow the product line. The other thing that's happened this year is there's been new applications starting to appear, which again look interesting, creating some growth and hopefully, depending how the industry works out, a lot of growth moving forward. There's the ORAN initiative, and there's also in terms of in data centers, in terms of using timing in data centers, and we are applying them. So I just wanted to take a few minutes out to look at both these things in slight more detail and take a case study to express, you know, why it makes a difference to us and why we have been able to make business there. So in the data centers, what they're realizing is that having all the servers in these data centers, if you imagine the huge warehouses full of tens of thousands of servers, and if they're all accurately timed to one another, it allows them to get throughput much higher. If you have a chance afterwards, you'll see at the bottom where it says learn more here, there's actually a YouTube video behind that we came across that was made by a guy. He's quite quirky the way he presents it, but he actually is very informative and explains why it's really important to the data centers to have accurate time. So we are finding that the data center people are interested in our Sentinel, which is a field product, because you can think of a data center like a mini network, and they're using it to test time across the whole data center to make sure that each of the servers are as accurately timed as they expect. So we've had some success there. We're looking to build relationships with other data center operating companies to actually see if we can expand that market for us. The second one I want to talk about was ORAN. Now, most of the standards bodies in telecoms, if not all of them, are always initiated by the operators. The operators like standards because they want interoperability. They want the ability to buy equipment from multiple vendors and build a network with equipment from multiple vendors so they don't get locked into one supplier, that they can choose to get competition. And in their view, they actually get more innovation across the industry as well if there's more people competing to come out with something different. And so the RAN network, which is the radio access network, you can think of it as the network close to the base stations, the mobile base stations that you see, was dominated by three of the large players, and still is dominated by three of the large players, Nokia, Ericsson, and Huawei. And so a number of the operators got together and created this initiative called Open RAN to try and split the network up into smaller chunks that other companies, like multiple companies, could choose to do a part of the RAN network rather than having to do the whole thing. And this was really to encourage more competition and innovation. And this, in the last period, this has definitely brought a lot of new people to our door, because they're obviously starting to implement the requirements in ORAN. Some of these require timing, some of them require network emulators as well. And so it's getting more opportunities in our existing customer base, but it's also getting some new customers to us, and some quite surprising ones. And this one example here, one of the tier one server manufacturers actually we've had good business over the last 18 months from them. So in their servers, they're actually implementing or showing that you can deploy ORAN type infrastructure in a cloud environment. You know, one of the interesting things that happened lately was when Facebook had a well publicized outage on their data centers for, I think it was half a day that went down. A number of mobile operators around the world found that they couldn't offer data service to the customers because they're actually hosted inside these data centers. So you can see that these data centers are not just about sitting there holding photographs and things you might look at one day. They're actually being actively used to host these software-defined networks. So the things are coming together, and we are actually seeing these companies that are building servers coming and asking to buy test equipment. So these are the same test solutions that we're selling to other people, but new customers that are coming to our door as well, and an interesting opportunity as it goes forward for us. So our strategy remains unchanged. This is, as I talked about earlier, there are two main drivers in industry: the build out of the mobile net infrastructure, often labeled the 5G, and also the cloud computing. These are the things that are creating huge amounts of interest, lots of innovation across the industry in terms of new interfaces, new frame structures, new equipment. Therefore, there's need for new testers as well, and that's what will continue to drive us. We also, as you know, in the past, we've done some acquisitions, and we continue to look for other opportunities to acquire companies. You know, test and measurement's not an industry that there's tens of thousands of companies in it. There's not even hundreds, but there are tens of companies. And we keep close contact with a lot of people looking for the right product that allows us to do one of two things: either get a new set of customers that we don't sell anything to today, or allow us to sell more to the customers that we do sell to today. So it's another piece of equipment that we can go and take more money off the table. And that ultimately is the aim in our growth strategy. We need to get more things that we can sell to people. So whether we do it ourselves or whether we do it by an acquisition, we are open to both. And if the right thing comes along at the right time, then we'll move forward and do that. So to summarise the situation for the last half, it's been very good for us. We've had a really good half. There's a lot of signs in there that give us confidence going forward. You know, the demand for telecoms test equipment continues to grow from our core suppliers, our core customers. We're seeing some new applications coming along. We're moving the products into new applications as well, which gives us confidence moving forward. There is the cloud around everybody at the moment, the global shortage of semiconductor products, and that looks like it's going to continue at least for another 6 months, 9 months, perhaps, hopefully no longer than that. To date, we've managed to navigate that without impacting any of our ability to ship product customer. We tend to sit with, because we are low volume, high complexity, we tend to have a reasonable high level inventory, which has helped us in this situation, but it's a continuous challenge trying to get equipment. But so far, that between our contract manufacturer and an R&D team, who sometimes have to go and look for replacement parts, we've managed to keep everything moving, and we continue to monitor that closely going forward until the shortage is cleared across the industry or across the world. But because of the background and growth that we've seen, the strong figures we've seen in recent time, then we go into this next period with very high confidence that we can achieve our results that we forecast for the rest of the year. And at that point, I'm going to open it up for some questions.
That's fantastic. Tommy, Ashley, thank you indeed for the presentation. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated in the right-hand corner of the screen. But just while the team take a few moments to review those investor questions submitted already, I'd like to remind you the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation has ended, you'll be redirected for the opportunity to provide your feedback in order that the company can better understand your views and expectations. Tommy, Ashley, before we move on to some questions we've received during the event itself, we did have a couple of pre-submitted questions. If I may, I'll just read those out. The first one reads as follows: how many engineers do you employ specifically to create new products or enhance the existing lineup?
Yeah, pretty much most of our R&D team are doing that. We have a support team, a small team that provides support in the engineering team, but the majority of them, about 90% of the engineers, are all working on enhancements. And as you know, our products are more platforms. We like to refer to them as platforms that we use for multiple years and keep adding more and more functionality on top of that. So the vast majority of the engineers are actually working on that type of environment all the time, bringing either new capability, small increments of capability onto what's there at the moment. When changes happen in the standards, sometimes you have to add a new measurement or some minor change, or some bigger changes as we've introduced, like support of the 400 gig interface, which is a fairly major project for us. But everything's really about the engineers are all working on products that will hopefully enhance the product going forward, that will encourage people to buy more, either upgrades or new products.
Fantastic. Thank you, Tommy. The next question reads: how many patents have you registered over the last 2 years? Do you expect to patent more IP in the next 2 years?
We haven't done a lot lately in the patent front. We have done some patents. We've got a number, but actually, when we started doing the Neo, we actually actively decided not to patent it, which may seem strange, but you know, our base is very wide, and really we get competitive advantage by being quicker than everybody else and being there faster. And one of the skills in terms of the very high accuracy timing is how you calibrate the instrument. Everything's a problem when you're trying to measure to a nanosecond of time. To give you a feel for what that means, a nanosecond, if you remember when you were at school or university, they told you that light went infinitely fast. Well, it kind of doesn't. It goes that far in a nanosecond. So suddenly when you're trying to measure to that or make equipment accurately measure to these, every path, every component's a problem, and how you characterize it, how you understand the delay through each path, how you then compensate for it, how you make sure it doesn't vary every time you switch it on, is really where a lot of the IP is in that product. And we felt if we put it in a patent, it was probably impossible for us to police it, to know whether anybody was copying it, because it's more about the technique of how to build it than it is in functionality. So we believe we stay in front, not through IP patents approach, but by IP from the point of view that being first, tracking the network, understanding what the future requirements are going to be required, and doing that quicker than anyone else.
That's great. Thank you, Tommy. The next question we've got here is: I understand the core of your technology is the exceptionally accurate time measurement and the automation of testing processes that require this. Could you please outline what are the natural adjacent market areas, i.e. the new business areas? What new business areas does your existing expertise leave you well placed to enter?
So really the telecom space was the first to really hook onto the value of accurate time across networks. And they've been working on it. And in some ways, if you look back, because we were fortunate when I started CALNEX back in 2006, I kind of stumbled across this application. And it's really taken the telecoms world about 10 years to really get it to work well and understand how to build high accuracy networks that deliver accurate time. And for a number of years, we've seen other sectors that have looked at it and thought that could be useful. Things like the data world, or the data center world, the financial world, the power industry, the automotive industry are now thinking perhaps time as an accurate part of your infrastructure is a useful thing to have. And so we're starting to see more and more people look at these. And there's been quite a change in the last couple of years where they've gone from thinking that could be useful to we need that. I was at a conference in Brighton just 2 weeks ago, and there was a number of people from the data center world, from the financial world, from the power industry says they need time. So in the financial world, high frequency trading, how do you know that a trade happened when you expected it to happen? because it's time stamped. What's the accuracy? Time's a relative term, and therefore they need to deliver high accuracy time to make sure that everything's aligned to the regulations that are happening there. The power industry needs time because power is coming from many different sources, and the synchrophasers need to be aligned to be able to measure power distribution across the network. And of course, you get the telecoms people. So we see, but it's fundamentally the same technology that's being used to transfer time. That method of transferring, just quite different applications. So some of these are starting to come alive for us. It all depends what level of accuracy they need. If you need accurate time to 2 seconds, then you don't spend a lot of money in test equipment. If you need accurate time to a few nanoseconds, you need to spend a lot of money in test equipment. And there's a spectrum there in terms of what accuracy they need for the application will actually ultimately decide whether it's an opportunity for us or not.
That's great. Thanks, Tommy. The final pre-submitted question we have here is, I see you're recruiting extensively with only a low number of applications per advert on LinkedIn. Are skilled labour shortages holding you back? Is staff turnover holding you back?
I wouldn't say we are trying to hire and we can't quite get everybody we want. I wouldn't say it's holding us back, but it's not allowing us to go forward as quickly as we'd maybe want to do. So it is a very competitive market out there for labour. I think we've all heard that. We've got a license to hire overseas, so we have recently hired people from India and Turkey and brought them to the UK. So we are managing to get people. It's taken quite a bit of effort. It's not holding us back. We haven't had much. We've traditionally had a very low turnover of people, and that's been pretty much the same this year. We haven't lost a lot of people. So we plan to continue to hopefully hire another 10 people in the second half, and we would expect to continue to hire into FY23 as well.
That's great. Tommy, fantastic. That's concluded the pre-submitted questions. If I may just ask you both just to click on that Q&A tab and perhaps start at the top. Where appropriate to do so, if you could just read out the question and give your response, that'd be fantastic. Thank you.
Okay, you want to go first, Ashley?
Yeah, well, there's right at the top there's a finance one, so I'll grab that one, and there's another one I can comment on as well. So Adrian C has asked question for me on the cash flow statement. Why is tax not being subtracted to derive the net cash from operating activities, and should we not start with profit after tax rather than profit before tax? So just a quick one on that. You can start with either. The statutory basis makes you start at profit before tax, but essentially that top part of the cash flow is to take your P&L and get the timing right so that it reflects the cash flows coming from that P&L. So you'll have some non-cash activities happening in your P&L, like depreciation, and you'll have some timing, like revenue being turned into actual cash coming in from invoices, which is dealt with in the working capital area. So for us, tax is non-cash at this moment in time. We don't actually pay cash out for tax because we have some protection at the moment from our R&D tax credits. So we start at profit before tax, because if you started at profit after tax, all you would do is add that back as a non-cash item. So it's not actually cash flow relevant for us. But even so, a lot of the time when you have tax in the P&L, that's not your true tax that you pay to the tax man in the year, just because of timing differences. So you've got to add it back and then add the P&L item back and then bring the cash flow item in later on. But if you're wondering why there's no tax at all on the cash flow, it's because we don't pay cash tax at the moment. So hopefully that's answered that question. The second question that I saw further down was, there's actually two questions from Morgan D, so I thought I'd just answer them both. Morgan's asked initially, are you able to give margin guidance, or at least broad guidance? So just from the guidance that's out from our broker guidance, Cenkos's guidance that's out there in the market at the moment, our gross margin guidance for this year and for next sitting at 75%. And that just takes into account, from what I was saying before, takes into account product mix and shipping mix as well. So that's the only guidance that we've got out there at the moment in terms of our margins, but hopefully that helps. And then your second question was, how do you plan to manage your cost base going forward? As you expect increased investment, does that mean OPEX will increase faster than revenue? Not quite. This is a strange period for the the comparative period. For us, because it's post-IPO versus pre-IPO, there is that step change that comes with listed entity type costs. So we wouldn't expect to see such a step change again, although our headcount will be growing. The cost base should increase incrementally from now on, not at the same rate as what we plan for our revenue growth. So it shouldn't grow as fast as the revenues if our planned numbers work out.
Okay.
Over to you, Tommy.
There's a couple here I can pick up, Ashley. Do you operate a SaaS model, a software as a service model? No, we don't actually sell very much at the moment. You can actually buy some of our products on that configuration if you want. You can either have a perpetual license or a timed license, as we refer to it. So you buy it in 3-month chunks. What we've tended to find up until now, especially in the R&D domain, our customers are really buying it from their capital budgets, and they really don't like it when they buy recurring type licenses, because quite often, as you know, when trouble comes over the horizon, the first thing that gets cut is capital budgets, and so they find they have no ability to buy the equipment they need. So we haven't actually pushed it too much. It's been valuable at times when our products can be quite pricey, and if they haven't enough in a budget, we can sometimes allow them to buy it in 2 stages. They buy the first part, buy some timed licenses, and then the second period, they then convert these timed licenses into perpetual licenses. And that allows them to manage their budget, and it allows us to avoid getting into a lot of discounting discussions. As I mentioned, we've got a new product coming out, a virtual version of the SNE. That's going into an environment where people do perhaps buy more software type products that are actually bought more on a timed license basis. So we will, with that product, offer it both as a timed license and as a perpetual license. And as far as we're concerned, we're driven by what is the best for the customer. And if they prefer either one, then we'll offer them that as a solution. Let me pick up one other question here, which is a good question. I see management has reported results ahead of expectation 3 times in the short period as being a listed company. Is this because management are deliberately conservative in the guidance to the market, or does it reflect inherent uncertainty, predictability of the business, and the timing completion of orders? That's a good question. I thought that would come in. You know, I think back in my past life, I used to have a manager that used to always say to me, a trend's a trend when it's a trend. And then actually I've found in this industry, there's times where you get a burst of orders coming in, you have a good period, and people are too quick to say that's a trend, it's all going up the way, when in fact it was a burst of orders. So we felt last year that we had a great year, but there wasn't enough conversion, there wasn't enough longevity in that to say it was a trend in the upward direction. I think that's definitely changed in the last period. Because of this period, we have actually now seen people coming back, buying a second one, buying more, getting into more areas. So, you know, we are always going to be slightly conservative. We want to try and meet and exceed our expectations. And I'm not going to call a trend when I don't believe it is a trend. But I think at this point, we actually are feeling more confident now in the next period. And hopefully we can deliver growth in the period ahead as well. Ashley, you got...
Sure. Yeah, sure. I've got a couple here as well. So James C, you've asked, do you expect the dividend to follow a typical 1/3 interim, 2/3 final profile? We've not actually had the discussion at the board yet in terms of what our final dividend profile is going to look like. So when we do know that, we will confirm that. But that decision is likely to be made closer to the full year results. And then there is a second question that I saw here. KT has asked what percentage of revenue comes from the recurring revenue compared to new sales. So as we were talking about previously, we don't actually have a recurring revenue apart from that 10% revenue, if you can class that 10% warranty revenue as it amortizes down into the P&L as recurring revenue. Our main bundled hardware and software revenue, we don't have recurring revenue, but we do have repeat revenue. So from a repeat revenue perspective, our repeat revenues for the last 3 years have averaged at about 80%. So 80% repeat and 20% new. So hopefully that answers that question.
Okay.
Over to you, Jane.
Yeah, I see Rick's asking a question. Somebody asked some further up there about manufacturing capability. I think this kind of captures both. You mentioned looking to improve manufacturing capability. Is this likely to lead to use of another contract manufacturer in addition to Kelvinside, or bring any production in-house? No, the kind of fundamental approach that we're taking is not planned to change at the moment. It's perhaps making us more able to change in the future if we choose to do that. What we're really talking about is just the way we work with a contract manufacturer, the way we manufacture. The products tend to be brought into house to do the final testing and shipping to customers. And in the early stages, when new hardware has just been released, a lot of the debug has to happen here using our engineers. So what we're looking to do is just improve the whole, mature the whole way that we go about this, forecasting to a supplier, working closely with Kelvinside, looking at the way we forecast future capability and whether there's a way that helps them procure material more effectively, make sure that we have more flexibility in a whole supply chain to wax it up or down as and when we need to do it. So that's really what we're looking to do. And at this time, we're not looking to change that relationship. You know, a lot of the value we get from Kelvinside's not just building it, but they do the procurement for us. And at this point, when the challenges that are happening in the world, you know, the good relationship we have with the procurement team in Kelvinside, with the engineers here, you know, is a key part of giving us robustness against the challenging situation we have at the moment. Ashley, have you got one you want to pick up?
Yes, actually one linked to that from Darren here saying, will your new VP of Operations spend time at the Kelvinside Electronics manufacturing partner? And the answer to that is yes. So a lot of his time will be spent on a day-to-day basis. He speaks to Kelvinside, and a lot of his time will be spent actually being at Kelvinside as well, just speaking to, as Tommy says, speaking to them on demand plans, etc. So there's a very close link between us already and Kelvinside. So it's just embedding our new VP of Operations into that process. So he's key to that. And there's sorry.
No, that's it. Let me just pick up. Melvin's asked an interesting question here. I think I need a pint for this one, Mike. But where do you see natural boundaries to CalNex's operations? Volumes or technical aspects or needs to telecoms or the speed of light time things? What about quantum computing in the future? Yeah, all these might happen, Melvin. You know, I always say that there's no boundaries. If there's a glass ceiling on CalNex, it's because we put it there. You know, I think as long as there's innovation happening, then there's opportunity. You know, as the point that they decide the telecoms network's finished, that's all we need. We don't need anything else. That's not a great day for the test world. But that doesn't sound like it's going to happen anytime soon. And I think you've seen so many exciting developments, new groups coming along, new areas. I think once the actual the infrastructure from the 5G paradigm gets out there, then it's going to create more applications. Other companies are going to come along and create new uses that will all end up changing our life, and that'll drive other innovations in the telecoms to be able to support that. So we see an opportunity coming all around us in all groups of people in the telecom space, in the datacom, and the financial world potentially. So there are many different areas where we can see opportunity coming in the future. Our challenge is obviously to keep connected to all these people and then being in the right place with the right discussions to understand where we can create business from it. Ashley, have you got a question?
Yeah, another one here from Adrian, going back to operating cash flow. Over the past 2 years, there appears to be greater cash flow in H2 than in H1. Is that expected in this financial year? So there's probably two trends. We usually see an uptick in a normal year. We usually see the revenues and orders slightly weighted to H2. It's usually about sort of 45 to 55% over the two halves. It will also depend on a large majority of our cash, as you might expect, comes in from Spirent, and that being our biggest distributor. So they're usually very good payers. It'll just depend on where their invoice cycle lands at the year end. The last couple of years, one of their big batches of invoice payments came in just before the year end. So we're hoping that will still happen this year, but if it doesn't land right at the year end, it will happen a couple of days later. So we're quite comfortable about that cash flow. In terms of the cash flow guidance that we've given for this year, from a prudence perspective, just because of everything that's happening out there in the wider world, we've kept the cash more or less in line with this half year. However, it'll all depend on that timing between those last couple of days of the year as to what we get in from trade debtors. Hopefully that answers that question.
And there's a question from Scott here. What kind of visibility do you have in your pipeline? So from booking an order to shipment, it's typically 4 to 6 weeks, depending which product line we're in, Scott. So the average is about 6 weeks. And actually, going back to the manufacturing, that's one of the things that we're trying to improve, is keeping it down nearer the 4 to 6 weeks. We've found when we introduce new products that are more successful than we expect, it's taken us longer than we'd want to get the lead time back down under control, and that's part of the kind of improving the manufacturing process. So we've got kind of 4 to 6 weeks from once orders are placed. In terms of new orders coming in, the sales funnel tends to give us about 3 to 4 months to 5 months of visibility. A typical deal takes 3 to 4 months to close. So from that, we've got a fairly good view for the kind of 3 to 5 month out from the sales funnel and active deals. And then past that, it's more about our market intelligence and understanding of the market and detecting the growth drivers that gives us the longer visibility. Ashley, have you got one?
Scott's actually asked the second question. Do you have a view on the appropriate level of cash on the balance sheet going forward? So for us, it depends on, as you'll know, our sort of third string for our strategy is M&A. Some of that cash that we've got on the balance sheet, if an appropriate opportunity came up, could be used for M&A, depending on the size. There is some capacity within the cash that we've already got at the moment for some small M&A deals. So in terms of the sort of surplus cash on the balance sheet, really just depends on non-organic activity that happens over the next few years as to what that appropriate level will be. But we're very much within the we've got quite a lot of capacity within that cash that we've got at the moment to be able to kind of run the operation, as you can see from the cash flow.
Tommy, Ashley, we're just coming up towards the hour, and every time you answer a question, another one comes in. So thanks very much indeed to everyone who submitted the questions. And of course, the company will review all questions submitted today, and we'll publish those responses where appropriate to do so on the platform. But just as we come up to the close, Tommy, perhaps I could just ask you just for a closing snapshot before we wrap up and redirect the investors to give you some feedback, please.
Sure. So it's been a really reassuring period for us. We've had an excellent period. We've exceeded our targets. We're feeling good about the next period, and that comes not from one thing. It comes from a number of elements. Both our base business and all three product families has increased. We're seeing new applications, which gives us confidence we'll find other new businesses as we move forward. And we've got some really good releases that our customers are giving us strong feedback from, that actually gives us confidence moving forward. So all things apart from the component shortage, which is out there, is a slight cloud that we all have to keep a very close eye on. But apart from that, we're feeling really good about the next period, and we hope we can continue to meet our expectations. So thank you very much, everyone, for coming along.
Fantastic. Tommy, Ashley, thank you again for updating investors today. Could I please ask investors not to close the session, as you'll be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of the management team of CALNEX Solutions PLC, we'd like to thank you for attending today's presentation. That now concludes today's session. Thank you and good afternoon to you all.